Welcome to the 94th episode of Kanga Crypto News, your weekly briefing for crisp, dependable updates from the crypto world. I am Kuba, and today we're breaking down a market under pressure. From record fund outflows and sharp price declines to what institutions are really doing behind the scenes. Before we start, a quick reminder. Everything you hear on Kanga Crypto News is researched and prepared by expert Kanga analysts using reliable sources only. But this is not an investment advice. We publish new episodes every Friday, so if you want to stay on top of the most important crypto stories, subscribe and turn on notifications. Now, let's get into it. Let's start with the biggest and most important story of the week. Crypto investment products recorded approximately $1.7 billion in net outflows for the second consecutive week, officially flipping year-to-date flows negative. Bitcoin-focused products accounted for the bulk of the damage, with roughly $1.32 billion redeemed. Ethereum products followed with around $308 million in outflows. According to fund flow data, this was not driven by a single event, but by a combination of macro pressure, geopolitical uncertainty, and expectations of tighter financial conditions. The key point here is structure. This was not panic selling from retail investors. These were large coordinated redemptions from institutional vehicles. The same investors who entered aggressively earlier in the cycle are now reducing exposure, rebalancing risk, and sitting on the sidelines. This is what a mature market looks like under stress. Capital rotates out when conditions tighten. It does not blindly hold risk. That pressure quickly showed up in price. During the week, Bitcoin fell sharply and briefly touched $73,000. Recording the lowest price in over a year. Ethereum followed with a steep decline of its own, breaking below several key technical levels. The move triggered more than $2 billion in leveraged liquidations across major derivatives venues. Long positions were wiped out as price accelerated lower, showing once again how fragile crypto markets become when leverage builds up during uncertain macro conditions. Liquidations clustered into short time windows, amplifying volatility and pushing prices below levels many traders expected to hold. Zooming out, the broader macro backdrop played a central role. Bitcoin and the wider crypto market slid below key psychological levels, including the $80,000 mark, as liquidity concerns intensified. However, Bitcoin and crypto is not the only thing that has seen such big drops. When we look at gold and silver, very traditional financial assets, gold dropped 20%, silver dropped 40%. That's a huge drop within the same time period as Bitcoin dropped 20%. So in the grand scheme of things, it seems like Bitcoin was the more stable asset here. Let us know what you think about that in the comments below. Despite the negative headline numbers, the ETF story was not one-dimensional. On February 2nd, Bitcoin ETFs recorded a fresh $562 million in net inflows, the largest single-day inflow since mid-January. BlackRock's IBIT and Fidelity's FBTC led the move. At the same time, Ethereum and XRP ETFs saw mild outflows, reinforcing a growing divergence in institutional preferences. Bitcoin remains the primary liquidity anchor, while secondary assets face more selective demand. This rebound came after an intense period of redemptions. Earlier in January, US Bitcoin ETFs saw as much as $818 million redeemed in a single session, the third worst outflow day on record. The contrast highlights how quickly institutional positioning can shift when conditions stabilize, even briefly. Institutional infrastructure also continued to expand outside the US. iShares announced the issuance of approximately 1.54 million new Bitcoin ETP certificates, now trading on the London Stock Exchange. This move increases regulated Bitcoin exposure for European investors, particularly pension funds and asset managers constrained by local frameworks. While this did not immediately translate into price support, it reinforces a long-term trend. Access continues to broaden even when sentiment is weak. Ethereum told a different story. ETF demand remained soft, but on-chain data and positioning trackers suggest continued accumulation outside of exchange-traded products. Entities like Bitmine and other large wallets showed signs of sustained Ethereum buying pressure, even as broader market flows remained negative. This divergence points to a structural shift. Some investors appear to prefer direct exposure or alternative vehicles over ETFs, particularly for Ethereum, where staking yield strategies and tokenized finance narratives still matter. From a technical perspective, indicators offered mixed signals. Relative strength indexes across Bitcoin and Ethereum dipped into oversold territory, suggesting short-term exhaustion. However, bearish momentum remains dominant, and analysts continue to flag the risk of deeper corrective levels if macro conditions deteriorate further. Weak ETF flows, tight liquidity, and cautious positioning suggest institutions are currently in wait-and-see mode. Capital has not exited crypto permanently, but it is clearly sidelined. So what does this week tell us overall? The market absorbed another $1.7 billion in outflows, but selective inflows and expanding infrastructure show long-term engagement remains intact. Bitcoin and Ethereum are diverging in how investors express exposure. Macro pressure continues to dominate short-term price action, while leverage remains the biggest risk amplifier. Short-term, the mood is defensive and volatile. Long-term, the rails of institutional crypto markets continue to build, even when prices are under stress. However, we see that current drop is not only in crypto. We see gold and silver levels going down as well. That's today's Kanga Crypto news. As always, if you enjoyed the episode, like, share, and subscribe to stay up to date with the most important developments in crypto. See you there.
We are Kanga, beyond crypto.